Good afternoon and welcome to the Mortgage Advice Bureau PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Head of Investor Relations, Mark. Good afternoon, sir.
Afternoon, thank you, and hello everyone. Thank you for your interest in MAB. Format for this meeting, I am going to give a short introduction to the business and the investment case for those that might not have met us before. I'll then pass to Ben, our Deputy CEO, to cover off the highlights from our first half of the year and an update on the market. Emily, our CFO, will then walk through our financial KPIs and update on capital allocation, passing back to Ben to talk about our strategic priorities, leaving plenty of time for Q&A. So MAB, on one level, is a network for mortgage advisors. Through our partner firms known as appointed representatives, ARs, MAB has over 2,000 advisors providing advice to customers on a range of mortgage and protection products. We provide our AR firms with mortgage and insurance panels, as well as support and services, including technology, compliance, training, and marketing. We're a B2B to C business, so we receive mortgage procurement fees from lenders, commissions from insurers, and client fees all wash through MAB. We retain a revenue share and we pay the rest away to our AR firms. This is a scalable platform business model. MAB has a nationwide UK coverage and a market leadership position with an 8.5% market share of new mortgage lending, where intermediaries do around 9 in 10 mortgages, as well as a 3% share of product transfers, and that's where customers stay with existing lenders and intermediaries do 1 in 2 mortgages. Where we're different from other networks is that MAB is a strategic partner for firms that want to grow. Our average AR firm has around 10 advisors compared to an industry average of just 2, and we help firms drive lead flow and recruit. Our proprietary technology platform is central to our strategy and differentiates us in the intermediary space. The other way we are different is that we selectively invest in businesses, forging even closer relationships and in some cases control of AR firms. And this gives us access to new markets and technologies. It improves our resilience and growth prospects and enables us to capture value. These invested businesses have higher advisor productivity and higher margins than our network firms. Lastly, I just want to emphasize the resilience of the group. We've had no shortage of shocks and challenges to the UK economy in the last decade, from Brexit to COVID, inflation, mini budget, and MAB has delivered comfortably double-digit percentage compound growth in revenue and in profits over the last 10 years. You might have some questions on the housing market and the upcoming budget, which of course are important, but house purchase activity is only 1/3 of our business, the majority being refinance and protection, where we have strong visibility. Ben, over to you.
Yeah, Mark, thank you, and good afternoon, everybody. I'm Ben Thompson. I'm going to take you through the quick highlights for our performance in H1, giving you sort of a light touch version of that and the main headlines. Emily will take you through the financial performance afterwards. I'll step on in a second to have a look at the market, sort of backward looking across the reportable period, which is H1, and to give you quite a bit of forward view as well. So if I just kick off, really, the highlights for us on the slide you see at the moment is our revenue significantly outperformed the market. Revenue up 20% in the period. Our adjusted profit before tax was up 18%, which also outperformed, and then particularly strong EPS performance or adjusted EPS performance at plus 23%, reflecting basically the full consolidation of one of our acquisitions from 5 years ago into the group. So we effectively get 100% benefit of that, hence the bigger figure. Two stories going on with our advisors. If I sort of jump back 1 second, picking up where Mark teed stuff off, historically we grew our advisors by 10, 15, sometimes 20% every year, and the top and bottom line growth typically followed. After the mini budget in 2022, the industry lost about 10% of its advisors, roughly. We lost far fewer than that, but there was a period where advisor growth was pretty much zero. What I'm delighted to say now is across this period, we've created some really good momentum in advisor growth, having grown 5% just in the first half alone. And we've got some good, strong growth post-period end going into H2 as well. So that advisor growth momentum is very much back in the business. The second area we focused on a lot at our Capital Markets Day back in February was just how productive these advisors are. So if we have over 2,000 advisors and we can increase their productivity, say by 5,000 a year even, that makes such a big difference to our top and bottom line. And of course, our margin as a group as well. What we've seen in the period is we've seen the revenue per advisor, so that productivity figure go up 14%. So there's real momentum also behind that productivity increase within the group as well. Very much a deliberate strategy reflecting more efficient tech and processes and a focus on our most productive firms. So that's a really good performance as well. Mortgage completions are 17% up in the period, just under 15 billion for the period. We'll probably do something like 30 billion in a year to give you an idea about the type of origination size. And actually that's plus 17% in terms of the overall market is against overall market growth of 6%. So 17 against 6%, significant outperformance. And the final bits, we've got some numbers on the right in terms of, or the bottom right, in terms of market share. One across house purchase and remortgage, which has grown in the period. And we've also been deliberately very successful with refinance, which is basically retention of customers, where our market share has gone up quite significantly in the period. So if I can just jump over to the next slide to look at the market. It's a really a funny half we've just been through, largely brought about because there was a stamp duty deadline which expired on the 31st of March, so halfway through our reportable period. So what you can see on the left-hand side of the table is we've got basically a purchase market that's grown 35% against the same period in 2024. And that does really pull forward quite a few home move completions in the period because of that stamp duty deadline. So a significant growth period for purchase in the market, against, to be fair, quite a soft comp in 2024. We kept pace with that market change, but on refinance, so across remortgage and product transfers where people stay with their existing lender, we significantly outperformed those segments. So overall, a very good period for us. And as I say, we've grown at 17% versus the 6% across the market. What we basically see through H2 is probably going to see a rebalancing of the purchase versus refinance mix. So I wouldn't be surprised when we get to the end of the year to see purchase clearly won't be up 35%. It will probably be up a bit, but we'll wait and see what it is by the end of the year. Refinance will most definitely be up. The reason for that is we've got a huge amount of mortgage maturities coming up in H2 from when the markets got really busy after the release from the COVID lockdown in 2020. So we're now seeing those 5-year fixed rates come up for maturity and they need replacing with lenders. And they started anger from literally the middle part of this year and go through very strongly in sort of July, September and December. So we can visibly see how much refinance is in front of us. Ditto next year, the year for refinance is going to be even stronger. It's forecast to be between 10 and 15% up versus this year alone, which is already a very strong year. So we've got total visibility of that refinance market and how we will hopefully perform across the whole of 2026. And ditto 2027 gets stronger because we're seeing a lot of people buy 2-year fixes this year. Over half our mortgage products are now on a 2-year fixed basis, which means 2027 and beyond will also be busy. The final bits I just bring out is some of the regulatory changes, which I'm going to go into a little bit later. So just a quick headline for me at this stage. Now we will revisit. We have seen a very different tone from the government through Treasury, through the FCA, the FPC and the PRA, the 3 regulators for our sector. And I describe it as a general sort of easing, still under the heading responsible lending, but fundamentally sort of the moves from the regulators are pro-UK economic growth and they're very helpful to our industry. And I will talk about that later because there's some real genuine positives in there for us as we look out to next year and beyond. So at this stage, I'll take a quick pause and I'll come back and talk about that in a minute and hand over to Emily for now.
Thank you, Ben. So I'm going to start the financial review with the income statement. So I was very pleased to report that MAB delivered very strong growth and financial performance in the first half of the year. And we clearly, as Ben mentioned earlier, we clearly outpaced the market. So our revenue grew 20% to £148 million, and the market grew 6%. So that's a significant outpacing. Gross profit rose 15% to 43.5 million, and that was supported by an increase in the proportion of house purchase transactions, which have a higher average case size, as well as growth in specialized lending. Our gross profit margin was lower by 100 bips to 29.4%, which reflects some investment in long-term growth, which we did return toward the end of this year and early 2026. Our adjusted PBT increased 18% to 14.5 million, which was slightly ahead of the 14 million we gave as a guide in July. Finally, our adjusted diluted EPS grew 23%, and that outpaced the growth of the adjusted PBT due to the consolidation of one of our subsidiaries, having now 100% of the profit contributing to the EPS. If we move closer to the revenue, please, Mark. Now let's take a closer look at the revenue. Our revenue, as mentioned earlier, grew 20%, and all of this growth was organic, driven by the expansion across our AR network, which was 18%, and also the AR firms that we have investment in for 22%. This performance really reflects our deliberate focus on advisor productivity and also expansion of advisor number. House purchase lending accounted for 54% of MAB's first charge lending, and that was up from 47% each in H1 2024. This mixed-in shift had a positive impact on procuration and client fee income. Protection income increased by 14%, with attachment rates marginally lower than in H1 24. This reflects the high protection focused on advisors during the softer lending market last year, rather than any underlying weaknesses in this year. Client fees also outperformed the market. Sorry, Mark, you need to go back one again. You're going too fast for me. 24% up versus H1, which was also driven by the higher purchase that I mentioned earlier. I think on the financial KPI, I pretty much covered the revenue, the gross profit, maybe the administrative expenses by 15%. And that's really reflects our ongoing strategic investment in technology, people, digital, and marketing that will underpin our long-term growth. I think we probably covered already everything else on this slide. Now moving to financial strengths and our shareholder returns. We have strong profit growth. Our strong profit growth has translated directly into a strong cash generation, and our cash flow from operations grew 15% to reach £17 million, and our conversion is still very high at 116%. I mentioned earlier the EPS that rose 23% to 18.2, and we still have a very, very strong balance sheet. Our net debt reduced by £5 million to 11.7, and our leverage is now at 0.3 times. So the consistent cash generation and disciplined debt reduction support our ability to invest for growth, pay dividends, and deliver the sustainable shareholder returns over the long term via our capital allocation framework, which is on the next slide. Please, Mark. So we earlier this year, we presented our capital allocation framework, and you can see here the order of priorities. So first, we need to make sure that we stay safe financially, and that's evidenced by our very low leverage as well as very high surplus of regulatory capital. We constantly invest in organic growth, which help us future-proofing MAB, and we spend about £4.5 million in this area. We are committed to our ordinary dividend. We have a policy of a 50% payout, a third being made at interim and 2/3 at the end of at the end of the year, and that was 4.2 million pounds. We completed on 3.2 million pounds of M&A deals, and any decision on surplus capital are made at final year, so it's not applicable for now. So I think that's it for me on the financials, and I will hand it over back to Ben to talk more about the strategy.
Thank you, Emily. And just a few things I just want to trot through on this slide before going through and explaining a bit more of the content in the boxes you can see on this slide just now. Firstly, I just want to remind or echo Mark's point on a very crude basis, our revenue basically is actually 1/3 purchase market, the rest being refinance and protection. Sometimes we're not perceived that way, but notwithstanding that, we still want to grow in the purchase market and we're very strong there. So I just want to talk a little bit about where we get our business from as well. And there probably is a slide in the appendices on this, but just at a very high level, we focus deeply on estate agents, on builders, on employers, and also in the last 3 or 4 years, we've deliberately been moving to try and access every digital channel you can possibly think of. So we're working closely with price comparison sites, with credit bureaus, with consumer platforms, and also through our own tools and our own brand digitally online, all to create new customer leads for our advisors and our network to make them more productive. That's fundamentally what we're all about. Every year, as we top the hopper up with more new business opportunities and new completed mortgages, we're increasing our retention opportunity as well. And as mentioned earlier, the area we've put a lot of focus on in the last sort of year or two is on customer retention. And we expect that success to continue in the years ahead. And that's so important because it's a big, very reliable and huge lump of business that comes through every single year. Customers have to remortgage. They can't sit on their variable rate. They have to address updating their mortgage. And that's a big, big opportunity for us, as I say. And that's very counter-cyclical, irrespective of what's going on in the economy or in the world for that matter, or even in the housing market in the UK. We still have that market plus protection. So a very strong point to make. We deliberately try and, probably get our tentacles everywhere in terms of where mortgages are researched and written. And we're doing that because, it's sort of a funny time at the moment where people have pretty much stopped walking into a bank or building society to get a mortgage. Lots of them are researching a lot more online. You've now got more recently the dawn of artificial intelligence and its relevance as well. So the idea really is to get absolutely everywhere where people are researching mortgages, and it's proving to be very successful. But we spent years building digital tools, nurture products, and all sorts of other retention products to try and make the very most of that opportunity so we can support our network. So I thought it's just worth running through that as well, because that's a very deliberate part of our strategy that's sustained and has been running now for a few years. If I focus a little bit more on the slide, on the left-hand side, I promised earlier I'd come back and talk a little bit about regulation, and I will stress it's a little bit about regulation, but it's all in the context of growth and change, and gives you a picture for how it's going to help our industry going forward and clearly help MAB. In a nutshell, basically, prior to the credit crunch, lending was probably a bit free. I know maybe more in the US than here, but there were obviously things going on in the UK that needed to tighten and change. Regulation tightened significantly following that, and in particular, again in 2014. And there's an argument to say, which I agree with, by the way, it became too tight and too restrictive. Consequently, 2 to 3 million people were locked out in renting and prevented from earning their first home or becoming a first-time buyer. Many of the policy changes that have been consulted on and put in place this year are very pro trying to get people out of rented into first-time owner occupancy. And in fact, the government has got a target of getting owner occupancy back up above 70%, where currently it's about 63, 64. And that would be brilliant for us because it means more housing transactions, therefore producing more refinance transactions every year. And that's really, really good. We're all about transactions, basically, and that would be very helpful. So we're doing an enormous amount in the area to try and generate demand and make people aware they can now get a mortgage where certainly 6, 9, 12 months ago they couldn't. So some of the things that have changed are, firstly, some of the lender affordability stress testing has become easier. It's still responsible, but those changes have made a difference. So our average mortgage size is about 200,000. So if someone could borrow 200 6 months ago, they can now borrow between 230 and 240. And why that's relevant is if I couldn't quite make that threshold as a renter, let's say a year ago, and I've gone away to try and save another 30, 40,000, one, it's very difficult to do it. And two, it's going to take a long time. So the fact I can now borrow that money today and maybe buy my first home is brilliant for me as a tenant. Our job is to make people aware that change has happened, and we're doing exactly that at the moment. But that's helpful to create a bigger market and get more people out of rented. Secondly, we've seen something called the loan to income thresholds change. I'm not going to go too jargonized on what that means, but in short, it means if I'm a lender, I can lend more freely to those trying to borrow a little bit more. And in particular, typically at the high loan to value end, which helps with the deposit size and a little bit of affordability stretch for people trying to borrow to get onto the housing ladder. And the third point being consulted on is the possibility that rental income will be able to be taken into account for mortgage underwriting purposes. And that is a really big deal if that becomes policy. And it's absolutely the right question being asked by the regulator. So the scenario being, if I'm paying £1,500 a month on rent, at the moment, my payments or my underwriting won't take account of the fact that I've been paying reliably to a landlord for a period of time, maybe 3 or 4 years. It will look at all sorts of other measures, and it will also stress test my affordability. So although I'm paying £1,500 a month on rent, and my new mortgage might be £1,100, I still might not get that new mortgage, even though it's costing me £400 a month less. So if those changes do come through, where rental is a big sort of factor in terms of mortgage underwriting and acceptance, I think we'll see a lot more first-time buyers unlocked into the market, which is very fair societally. It's very, very good for MAB as well. And I think the final point I just say as a headline, rather than again going through some of the industry terminology, is it will become easier for customers to remortgage versus how it was 6 months ago. And that's good from us from a margin perspective. It's also, more importantly, very good for customers as well. So those are the main regulatory changes. And then on top of that, you've got the big government push for house building, which has been very public about. You've probably seen huge coverage on it in the press in the last year or so. I think all the planning reforms and all the efforts to get builders building are proving tough, but that momentum inevitably is going to come through because there's a real determination behind that. Where it's relevant for MAB is we over-index in new build. So helping people who are buying new homes and sorting their mortgages and helping them to move into their first, second or third homes that happen to be new, we've got about a 20 to 25% market share. So when that market starts to go, which it will, you'll see our market share rise at a faster pace, which will be brilliant. In the second block, I'm not going to talk too much about data or in fact, for that matter, AI or digital tools, but there's some key areas of focus for us that probably the head office level, there's things we do quicker and better and cheaper. And we're already deploying some tools with our staff to try and help them complete tasks more quickly. And that efficiency eventually is absolutely going to come through in the numbers. More importantly, we're looking at how we can help customers on board with the assistance of AI agents and tools. You know, that's now very relevant and very helpful to customers. And we've just been doing that for the last couple of months. And then the third area we've been focusing on for quite some time now is how, if I go back a year or so ago, it used to take about 10 hours to do a mortgage from beginning to completion for someone buying a home, which is a long time. What we've always felt is if we can get that timeline down to about 5 hours from 10, you're clearly going to have an advisor that in theory is twice as productive. And that's what's behind some of my comments earlier around advisor productivity. So our growth in the future will be, yes, we're going to have many more advisors join MAB, but they're also going to become more productive. And that's going to pull through to our numbers impressively as well. So the reason you've seen the productivity go up is one, because we focus more on growing our most productive firms, but two, in particular, we now have tools that complete the mortgage process more quickly. So that's really where a lot of our sort of tech and more recently AI efforts have gone into. And then the final piece is just picking up on how Mark positioned the business at the beginning. I would kind of describe we've got the traditional, what I call network model, which is similar to a franchise model. So we've got thousands of advisors who are basically using our compliance and technology and marketing and business development support. And then we've got a very small number of very select businesses that we've either bought wholly or we've invested majority stakes in over the last sort of 5 to 10 years, deliberately to get us into specialist markets and to scale. So what we do is we put best practice in place with those firms where they typically employ the advisors. We help to feed them lead generation. And again, they become more productive and they grow, and that best practice spreads across the network as well, which is brilliant. So deliberately, we want to have that degree of control with a small number of firms. It's not many, so we're not about to go out and buy lots of new firms, but we have got a slight balance with a different margin perspective, which perhaps we'll tackle in Q&A, But the margin in the businesses we've invested in or we own are obviously significantly higher because we're pulling through all of the financials. So I think that's all I'm probably going to say on strategy, except I'll go back to Capital Markets Day. We've got a very strong and clear commitment to pretty much, well, basically to double the business. That's my simple description of it, and become more efficient. I'd say we're very much on path and on track with that. So as I jump over the page to slide 14, just consistent with that last point, what we're sharing with you here is really just sort of transparent progress following the February Capital Markets Day, where we signposted we would deliberately consolidate in a small number of very successful businesses, i.e. with higher stakes for MAB in those businesses. We've done that mostly through the MAB brand, but also we've used our wholly owned First Mortgage brand, very successful fee-free mortgage broking business we acquired in 2019, to buy another business or two across the period as well. So you just got a summary table there showing we've delivered what we said we would back in February, and we're rigidly sticking to our plan to double the business in the next 5 years per our Capital Markets Day promise. So at that point, I'll take a pause and probably hand over to Mark to give a pretty positive summary and outlook in terms of where we are.
Thanks, Ben. Yep, I won't read through all of this. Suffice to say that the business is trading well, and we've got pretty good visibility, given the nature of our refinance business, with a product end dates giving us good growth in 2026 on 2025. If we move to Q&A, do please keep submitting some questions. I've got a good few to start us off with. We've got one here from Stuart asking, what impact do you expect from government housing and home ownership initiatives on your growth prospects? Probably one for you, Ben.
Yeah, I'll take that. And hi, Stuart, and thank you for the question. I'm very positive about it, even though I know much of the press narrative is it's taking longer than it should do. You're never going to build 1.5 million homes, etc., etc. You know, there's a real determination behind getting construction going in the UK for residential housing. That's got a stronger tone than I've seen before, and I do believe it will get going. It's just going to take time to do so. So I think that sort of the house building target is eventually going to catch up. Whether they get to the 1.5 million or not, I don't know. But that momentum, as you look out into the short and medium term, is clearly going to start to get going, and that's really good for us, as I say, because we over-index in new build, and it's going to create more transactions in the market, which is really, really good for us as well. The second point to the question, just reading that again, there is a wider aim to get more people into owner occupancy, away from rented. And a lot of that is about, I think, trying to create the ability for people to own their own homes. So in the longer term, they can draw upon housing equity for pay for certain things. So if I'm thinking about private health, I'll think about pension provision, maybe even helping children to get on the property ladder. None of that can be paid for by the state. So we're better off having 70% plus people own homes like we did 20 or so years ago. And I think that's a positive move they've got right as well. So I expect in time, when they finally have some money to give away in tax incentives, don't know when, they might have a little bit to give away and stimulate demand in the market. But for now, it's all supply focused, and we're really pleased with what they're doing.
Thanks, Ben. Probably one for you, Emily, around capital allocation. A question from Martin saying, what explains the reduction in the interim dividend, and how should we think about the payout policy going forward?
Yes, so back in February, we announced a new capital allocation policy, which was a lot more aligned with our growth plan, which was to double, our business basically in the next 5 years. So we needed to be able to invest more of our surplus capital into organic growth or even some of the M&A activity. The capital allocation, especially as it refers to dividend now, is we have a 50% payout ratio of ordinary dividend, and a third of that on a full year basis, right? And a third of that is paid at interim, and 2/3 will be paid at final, which is paid in May. And then after that, it will be progressive. The reason why we did this is not to take away returns to our shareholders, is to have flexibility to do other capital actions, including potentially additional dividend or even share buyback.
Very good. There's a question here talking about the planned move to main market, how that supports the next phase of growth. I can have a go at that. So MAB listed on AIM in 2014, market cap of around 80 million then. It's been very good for us and good for our shareholders. We, earlier this year, Capital Markets Day, spent a lot of time deep diving on the strategy, how the strategy is evolving to sustain our leadership position and underpin those medium-term growth objectives. Moving from AIM to main market just feels like a natural step in that growth in that growth journey to appeal to the broadest pool of investors and to enhance the market profile of the business. Question on returns from Tom. I think, Emily, this is probably one for you around M&A. What are your return expectations on recent acquisitions? How quickly do you expect them to be accretive?
Yes, so we don't accept any deal at MAB that doesn't give us a pass of 20% IRR within 3 years, maximum 5 years for maybe certain technology investment. So all of the deals that you see here, they're going to be accretive pretty much straight away because they all make profit already. We know the one, especially the one that we closed in the first half. We know those businesses. They are actually minority investment that we are consolidating into MAB now that we're ready to really grow them very, very fast. And so you can rest assured that we have a very kind of deliberate way of calculating return before we make any investment decisions.
If there aren't any more questions, then I think we're at time. Last chance for questions. Otherwise, I'll just thank you all again for your interest in MAB. If you've got any follow-ups, do please reach out to me. In the first instance, you can find the investor relations email address on our website.
That's great. Thank you all for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of Mortgage Advice Bureau PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.
Thank you, everybody.